This cash pile is a hot gossip on the tons of investment industry. Why Warren Buffett has to keep this much amount of money in cash rather than in stocks? Well, the amount which is represented here has been invested in the treasuries or government bonds yielding interest, which are also known as T-bills. If we quantify this amount in terms of percentages, this is the total of 30% of the Berkshire Hathaway's total portfolio. And since 2022, he has been adding up the cash in the portfolio, and the main activity of the Warren Buffett is to sell stocks. The question is why Warren Buffett is keeping money away from stock when the whole purpose is to invest in the stock market. Macroeconomic conditions tells us a lot of money managers or people are actually investing in treasuries or T-bills or simply the money market funds. Why? Because the return on them is right now 5%, and on the other hand the stock market is yielding around 3%. This cannot be the answer. Thus these money managers are prioritizing the short-term gain over long-term gain. Actually the Warren Buffett cannot certainly do that. If we look under the hood, the story further goes into the real returns or real interest rates, which are actually the return on the government bonds excluding the inflation rate, and which is right now actually 2% since early 2023. Okay, this is an interactive return because we cut out the inflation. It turns out to be a good thing, but this cannot be the only reason, because who the hell knows that the stock market is gonna perform so dumb against the money market funds. Yeah, the safety of the treasury base is a perk, but for a person like Warren Buffett, this cannot be the only reason to invest in T-bills. If we look closely into the financial assets in the money market funds, there has been 4 instant spikes. One before 2000 crisis, another before 2008 crisis, another before the pandemic, and another before, recession? No. Is Warren Buffett predicting a recession? If we look into the specific indicator, which is the most common recession indicator, which is unemployment rate, and plot it against the real interest rates, we can clearly see when there has been a big spike in the unemployment rate, the real interest rates become negative. And if Warren Buffett is predicting a recession, because when people save up more than investing in new projects or employing more people, the recession actually happens. And this has been the case before every recession in the history. And then the unemployment rate spikes up and the real returns drop, which turns out to be beneficial for an investor like Warren Buffett. Because during the recessionary times, the stock market is trading at a bargain price, and on the other hand Warren Buffett has saved up enough cash to buy it. And now let's suppose if it's not the case, why he's piling up this cash? Because he's not a big fan of economics, he can solely make a big acquisition in these recessionary times, as a lot of his target acquisition companies, God and only Warren knows which are the targets. And generally every corporation which has saved up money in these non-recessionary times will invest and use that money during the recession, which will again boost up the stock prices of companies. As during recession, saved up money is used, or the new money is applied with low interest rates, which actually make the real interest rates negative, and that money is actually used to lower the unemployment rate, which is the perfect recipe of an economic boom. So a big acquisition at the start of a recession can turn out to be a profitable for an investor like Warren Buffett. But what about the less good looking opportunities in the stock market right now? Yeah, this can be the case why Warren Buffett is not investing in the stock market but piling up the cash because of the less good looking opportunities in the stock market. This actually fits in the Warren's way of thinking. Overvaluation of the stock market can be measured by the price of the index in terms of the earnings or the yield of the index. And during recent times, these earnings are way less than the earnings from the treasuries because the index now costs more due to overvaluation. Yeah, index reached a lot of times all-time highs during 2024, like 57 times. So generally it's hard to find good looking opportunities which are undervalued in the stock market. This theory can be validated by the Buffett indicator, which is used by the Warren Buffett, which actually measures the relative value or market capitalization of the stock market in terms of the GDP of United States, which is reaching same kind of levels like pandemic levels. Also, if we go and compare the stock market valuations with its past, we may find out that the forward PE ratios has reached the same kind of levels like the year 2000 and the year 2021, which are known for the most notable stock market crashes due to the stock market frenzies, like dot-com hype or tech or meme stock frenzy. So AI can be a catalyst, ending this overvaluation unless the earnings increase otherwise, as these AI stocks accounts for most of the index right now. If there will be a correction in the valuations of these stocks, there will be spillover effects across the stock market. And yes, then Warren Buffett can inject these reserves into the stock market due to cheap prices. Okay guys, this is all for today, and if you got some valuable information out of this video, then don't forget to show some support. Bye.